Well, Canada's first interest rate hike since 2010 could be less than 2 weeks away, and it's because of several positive factors. Stats Canada reports solid economic growth in April, building on a strong first quarter, while a Bank of Canada survey shows that positive business sentiment has hit its highest level since 2011. Economists say the new data suggests the economy is improving, likely leading to a central bank rate hike. So, what would rising interest rate mean for you? My next guest says there's no need to panic for now, but Canadians should use restraint and be patient. Lesley-Anne is an author of several personal finance books, including Rich by 30, and she joins me now in Toronto in our studio. So now this possible rate hike could be minimal. We were talking about 0.25% is some of what's written out there, yet it may indicate that the low interest rate era could be ending. But you say no need to panic.
I wouldn't. We have a little bit of runway here. Often these rates are incremental and they'll happen over the next few years. So it's not like we're going from a 5-year posted rate that you can now secure maybe at 2.6, 2.4 to 3.6 or 3.4. We have a little bit of time. So what I recommend is that you plan for this upward trajectory in the next few years.
So in terms of planning, let's use your case as an example here. You just recently, you were saying, renewed your mortgage as well. So tell us a little bit about that and how you're using this information too.
So I actually just renewed my mortgage last week. And I thought back to when I bought my first home at the age of 21, and I paid 4.9% for my very first mortgage. I renewed last week for 2.49%, and that is significantly different. What it means, though, for buyers is that more of your mortgage payment goes towards the actual principal and less towards the interest. Now, when rates go up, more of that payment goes towards interest and less towards the principal. So the payment itself might not change, but what goes towards that principal amount will.
Now, I believe you got a fixed mortgage, right? A fixed rate. So is there a definitive answer whether people should opt for a fixed or a variable mortgage knowing that this rate hike is coming?
So in my case, I do think that rates are going to be increasing, so I chose to go with a fixed. But for many years, I've been very comfortable with a variable rate on my mortgage. That allows you to generally benefit from a lower interest rate. But what's going to happen is that's the rate that's going to be increasing and having, I guess it will make buyers that are on variable rates a little bit more vulnerable to those increases.
All right, and for those who are thinking of getting into the market now, how would this affect affordability?
Well, I actually think this might be a good thing. So a slight rise in interest rates can put some cooling effect in the market. So let's say you were looking, you might now have more options, and optionality is very valuable. So if you were thinking of making a trade-off and not getting that parking stall with your condo, maybe now you can get that parking stall with your condo for a similar price point. So this isn't necessarily a bad thing, but what it will mean is when you're looking at those roster of rates, so you go to the bank, you're meeting with your broker, they might be a little higher than they were even just a month ago.
Right, so as you're saying, don't use this information for panicking, but more for planning.
That's right.
Thank you so much for this,
Thank you for having me.
Lesley-Anne is a personal finance author based in Toronto.